All of these insurance products require an agent to have proper FINRA securities registration in order to sell them, except for variable life, modified whole life, universal variable life, variable annuity. The correct answer is modified whole life. Any variable policy is tied to investments. Any person wishing to sell policies tied to investments must have proper FINRA securities registration. Whole life and term life are not tied to investments, so FINRA registration is not required to sell these types of policies. A variable insurance policy guarantees a minimum rate of return, does not allow the policy owner to assume the investment risk, does not guarantee a return on its investment accounts, does not guarantee an assignment provision. The correct answer is does not guarantee a return on its investment accounts. A variable life policy has a benefit tied to its underlying investment portfolio. Unlike ordinary life policies, the policy owner of a variable life policy manages the investments tied to their policy in a separate account, assuming all the risk with no guarantee. Which of these is an element of a variable life policy? A fixed level premium, insurer assumes the investment risk, no investment risk to the policy owner, rate of returns are guaranteed. The correct answer is a fixed level premium. Although the policy owner controls the investments of their account, they do not have any control over the premium of the policy once it is issued. The premium for a variable policy remains fixed and level. A life policy with a death benefit that can fluctuate according to the performance of its underlying investment portfolio is referred to as adjustable life, graded premium life, variable life, modified whole life. The correct answer is variable life. The policy owner controls the investments tied to the variable life policy. There is no guarantee of returns, and the performance of the investments will directly impact the death benefit. Which policy requires an agent to register with the National Association of Securities Dealers before selling? Variable life, credit life, universal life, interest-sensitive whole life. The correct answer is variable life. Variable life policies are tied to investments like stocks, bonds, indexes, and mutual funds. Since the policy involves investments, the agent is required to pass additional exams and register with FINRA, NASD, and the SEC. How does a typical variable life policy investment account grow? Tied to the price of gold, through mutual funds, stocks, bonds, based on returns from the insurer's general account, tied to treasury bills. The correct answer is through mutual funds, stocks, bonds. With an ordinary life policy, the insurance company maintains and controls a general account for which it funds all of its policies. In a variable life policy, the policy owner controls and maintains a separate account tied to stocks, bonds, or mutual funds and is in control of the account's performance. Which of these life products is not considered interest sensitive? Modified whole life, variable universal life, interest sensitive whole life, variable life. The correct answer is modified whole life. Most whole life policies come with a guarantee from the insurance company that the face value will pay as agreed as long as the premiums are paid. Variable life policies do not typically come with that same guarantee, as the face value is said to be interest sensitive or based on returns. If a policy is an interest sensitive whole life or a variable whole life, it falls under both categories. There is a guarantee, but it is also interest sensitive. Which of the following statements about a variable whole life policy is correct? It provides a minimum guaranteed death benefit. It is a combination of a limited period endowment and a decreasing term policy. Its premiums and benefits are variable. It has a guaranteed rate of return. The correct answer is it provides a minimum guaranteed death benefit. A variable whole life policy is both an insurance and a securities product. It has a guaranteed death benefit, but also as a separate account of investments managed by the policy owner to give the policy owner the opportunity to earn a death benefit above the guarantee. What type of life insurance incorporates flexible premiums and an adjustable death benefit? Endowment policy, modified whole life, decreasing term, universal life. The correct answer is universal life. Like a universal remote, a universal life policy provides the policy owner with many options. A universal life policy owner can adjust the premiums and the benefits at any point during the policy. This is typically done through manipulating the cash value. Even though a universal life policy owner can control most of the policy, they typically cannot control the investments funding the policy. The investment gains from a universal life policy usually go toward the death benefit, the dividends, the cash value, paying off a policy loan. The correct answer is the cash value. Any investment gains from a universal life policy will go directly into the cash value. It is through manipulation of this cash value that the policy owner gets all of their control. Which is true concerning a variable universal life policy? Policy owner controls where the investment will go and selects the amount of the premium payment. Policy owner has no say where the investment will go, but can choose the premium mode. The investment vehicle for this type of policy is held in the insurer's general portfolio. The death benefit can vary, but the policy owner has no say in the premium amount paid. The correct answer is policy owner controls where the investment will go and selects the amount of the premium payment. A variable universal life policy is a combination of both a variable life policy and a universal life policy. These policies put the policy owner in complete control. They can control the premiums, face amount, and investments. All of these statements about equity indexed life insurance are correct, except cash value has a minimum rate of accumulation. If the gain on the index goes beyond the policy's minimum rate of return, the cash value will mirror that of the index. The premiums can be lowered or raised based on investment performance tied to an equity index, such as the S&P 500. The correct answer is the premiums can be lowered or raised based on investment performance. An equity index life insurance policy is a variable life policy. With a variable life policy, the policy owner can control the investments and impact their death benefit, but they cannot adjust their premiums regardless of how their investments are performing. Which type of life policy contains a monthly mortality charge as well as self-directed investment choices? Joint life, adjustable life, variable universal life, universal life. The correct answer is variable universal life. Variable policies contain self-directed investments, leaving the policy owner in charge of the overall performance of the policy's investments. Universal life policies have a monthly mortality charge that is paid with a combination of premiums and cash value. A variable universal life policy gives the policy owner complete control of the investments and has a monthly mortality charge.